All right, so hello everyone. This is Kim Kleiman from steadyoptions.com, and we're going to talk about straddles today. So let's start with some introduction. For those not familiar with straddle strategy, it is a neutral strategy in options trading that involves simultaneously buying a put and a call on the same underlying strike and expiration. The trade has a limited risk. The risk of the trade is basically the debit that we pay for the trade, and unlimited profit potential. Now, if you buy different strikes, the trade is called a straddle. How we execute a straddle? We usually execute a straddle by simultaneously buying the call and the put. Now, most brokers would allow you to do it with a built-in strategy, with interactive brokers, Thinkorswim, and most other brokers. They have a list of predefined strategies, and Straddle is one of them. So what you just do, you just build a strategy according to, you just build the trade according to what you want to buy. So if you want to buy Straddle, let's say Apple Straddle with a 115 strike, you choose a straddle from predefined list of strategies. You specify the strike and expiration, and that's it. Now you can log in by buying calls and puts separately, but it will expose you to directional risk. So most of the time, I don't recommend to do it. For example, if both calls and puts are worth $5, you can buy straddle for $10. And if you buy the call first, you basically become directional, you become bullish. So if the stock moves down, the calls you own will decrease in value, but the puts will be more expensive to buy. So the whole structure, the whole straddle will be basically more expensive to buy. And this is why I don't recommend legging into the straddle. I recommend, especially for beginners, I recommend to do it as one transaction, buying puts and calls as one transaction. So options guide explains straddle. Long straddle options are unlimited profit, limited risk option trading strategies that are used when the options trader thinks that the underlying securities will experience significant volatility in the near term. And maximum loss for long straddles occurs when the underlying stock price on expiration date is trading at the strike price of the options bought. At this price, both options expire worthless, and the options trader loses the entire initial debit taken to enter the trade. And also definition by Investopedia. Straddles are a good strategy to pursue if an investor believes that the stock price will move significantly, but is unsure as to which direction. The stock price must move significantly if the investor is to make a profit. Should only a small movement in price occur in either direction, the investor will experience a loss. As a result, a straddle is extremely risky to perform. Now, we will see that the straddles that we trade at Steady Options are not as risky as they seem, because we're trading very specific type of straddles, and we will see it later. So right now we can go and see some example. For example, if Apple currently trading at 130, well, this was in May 2015 when Apple was 130. So you can buy a straddle by buying 130 put and 130 call. And this is how the P&L chart would look like. Okay, so we can see some more recent example. we can see how Apple Straddle would look like yesterday, November 17. So when the stock price was at 114, and I specifically selected the time when the stock price was exactly at the strike, we can buy 114 calls and 114 puts, expiration going 17 days out, October 4th, the weekly options. And we would pay $477. And this is how the P&L chart would look like. So we can see that we really need the stock to move. So for example, if the stock moves to 117, the trade will be up 15%. If it moves down to 111, 110, it will be up 14, 13% as well. So we don't really care which direction the stock moves as long as it moves. As long as it moves, we will have a profit. So where is the catch? The problem is that if the stock doesn't move, the trade will start bleeding money every day because we have negative theta. So let's see what happens, for example, 1 day out. By the way, the software I'm using is called Option Net Explorer 01. And this is software that I highly recommend. I personally using this software, and many of our members are using it. It's very powerful software. It's not expensive compared to some other products on the market. And our members also get a 10% discount. So let's see. You can basically, what you can do, you can go a few days in the future and see how the trade performs. So for example, if you go 1 day in future and the stock doesn't move, the trade is already down 3%. If we go 7 days, 1 week in the future, the trade will be down 23% if the stock doesn't move. So as we can see, especially with a relatively close expiration, we really need the stock to move. Otherwise, the trade will experience a serious loss. And if we go another few days, you can see we're already down 36%. Now this, assuming all other factors equal. For example, we didn't adjust volatility. If we do adjust volatility, for example, if we go today and we increase volatility by just 3%, we can see the trade is already up 12%, even if the stock doesn't move. And this is basically the key to what we're doing with our earnings straddles, as we will see. Okay, so let's go back to the presentation. So how straddles make or lose money? As we could see with the P&L chart, a straddle is vega positive, gamma positive, and theta negative trade. That means that all other factors equal, the straddle will lose money every day due to the time decay, and the loss will accelerate as we get closer to expiration. So what does it mean? Let's bring volatility back to 0. So let's say today the negative theta is only $14. But as we go and get closer to expiration, the theta will become much higher. Now we already minus $15. We get closer to expiration, we already $19. So as we get close to expiration, the negative theta will accelerate. So for the straddle to make money, one of the two things, or both of them, has to happen. One, the stock has to move. no matter which direction. And as we go with close expiration, the stock has to move much quicker. If we go, for example, with expiration 2 months out, the stock doesn't need to move as quickly as if we go with expiration two weeks out, because the theta is not as big when we go 2 months out as it is with 2 weeks. So the closer expiration we go with, the more aggressive the trade becomes. The negative theta becomes much more bigger, but we will also have higher gains if the stock moves. So this is one thing, the stock has to move. Second thing that has to happen is the IV, implied volatility, has to increase. Now, if both things happen, then the gain will be probably bigger. If only one of them, then it depends on some other factors. So Straddle works based on premise that both call and put options have unlimited profit potential, but limited loss. So when one leg of the straddle loses up to its limit, the other leg continues to gain as long as the underlying stock rises, resulting in overall profit. When the stock moves, one of the options will gain value faster than the other option will lose, so the overall trade will make money. And if this happens, the trade can be closed before expiration for a profit. All right, so when to use a straddle? Straddles are a good strategy All right. Straddles are a good strategy to pursue if you believe that the stock price will move significantly, but unsure as to which direction. Another case is if you believe that implied volatility of the options will increase, for example, before a significant event like earnings. And this is basically exactly what we do with steady options. So when we have earnings that come in 1, 2, or 3 weeks, implied volatility usually increases sharply a few days before earnings, and the increase should compensate for the negative theta. If the stock moves before earnings, the position can be sold for a profit or all to new strikes. And this is one of my favorite strategies that we use in our model portfolio for consistent gains. Now, many traders like to buy straddles before earnings and hold them through earnings, hoping for a big move. While it can work sometimes, personally, I don't like it. And the reason is that over time, the options tend to overprice the potential move. We're not the only one that know that the earnings are coming. So other traders also bid those options, and they become really expensive before earnings. And after earnings happen, those options experience huge volatility drop the day after the earnings are announced. And in most cases, this drop erases most of the gains, even if the stock had a substantial move. And we can talk about it a little bit more later. So how does it work? Buying a straddle before earnings. So basically, it all started when I came across an excellent book by Jeff Hogan, The Volatility Edge in Options Trading. And one of the strategies described in the book is called exploiting earnings-associated rising volatility. Here is how it works. Find a stock with history of big post-earnings moves, buy a straddle or a straddle for this stock about 7 to 14 days before earnings, sell just before the earnings are announced. Now, we tweaked this strategy a little bit for our needs, and right now what we're doing, we're not necessarily looking for a stock with history of big post-earnings moves. Many times, we're just looking for a stock that had some decent move, maybe 3, 4, 5%, And we can still, if we enter at a reasonable price, we can still make money due to increasing implied volatility of a stock move. And we will see some examples later. So implied volatility usually increases sharply a few days before earnings, and the increase should compensate for the negative theta. Now, of course, like every strategy, the devil is in details, and we need to address the following questions. Which stocks should be used? So I tend to trade stocks with post-earnings moves of at least 5–7%. Again, this is not a firm requirement. Sometimes we trade stocks which have smaller moves. The important thing is to enter at a reasonable price. When to buy? So implied volatility starts to rise as early as 3 weeks before earnings for some stocks. For other stocks, it happens just a few days before earnings. So we have to find the balance between buying too early, and if you buy too early and implied volatility doesn't start to move, negative theta will start to kill the trade. If we buy too late, we might just miss the big portion of IV increase. So for most stocks, 5 to 7 days usually works the best. But again, it's not it's an average. Sometimes it's 3 days before earnings. Sometimes it's more. It really depends on the stock, on the price, on many parameters. Which strikes to buy? Now, we usually prefer to buy straddle, which means that it's the same strike. And the strike is the closest to the current price. For some higher price stocks, we might buy a strangle, which means, for example, if a stock is priced at $200, we might buy strangle, for example, 210 calls and 190 puts. We don't want to go too far out of the money because, well, this will be more aggressive trade and we need the stock to move more before earnings. But for me, the straddle represents the best compromise between risk and reward. Now, under normal conditions, and by normal conditions I mean no big event like earnings involved, a straddle or a strangle trade requires a big and quick move in the underlying. If a move doesn't happen, the negative theta will kill the trade. But in case of pre-earnings strangle or straddle, the negative theta is neutralized at least partially by increasing implied volatility. Now, in some cases, the theta is larger when the implied volatility increase, and in this case, a trade will be a loser. However, the losses in most cases are relatively small. Typical loss is around 7 to 10%. In some rare cases, it might reach 20–25%. I believe actually that our maximum loss since inception in 4 years was around 25%. And it was fairly rare when it was 20 to 25%. Most of the losses are around 7, 10, maybe 15%. But the winners usually far outpace the losses, and the strategy is overall profitable. Market environment also plays a role in this strategy performance. So if we buy straddle, for example, when overall volatility is relatively low and volatility is going up, then the straddle will probably perform the best. If we buy straddle when volatility is already high, it will be a little bit more risky because we need volatility to remain high in order for the trade to make money. Otherwise, if overall volatility will go down, it might impact the implied volatility of the straddle as well, and the trade could be a loser. So the strategy overall performs the best in a volatile environment when stocks move a lot. If none of the stocks move, most of the trades will be around break even or maybe small winners. But fortunately, over time, stocks do move. And in fact, big chunk of the gains come from stock movement and not IV increase. So basically, we probably need both. We need IV increase and we need stock movement in order to make money over time. Which one has more impact? It's hard to say, but again, ideally, we would like to see both IV increase and the stock moves. Now, would you like to rent your options for free? Because basically, this is exactly what we're doing with this strategy. So let's go a step back and see the real rationale behind this strategy. So when someone starts trading options, the first and most simple strategy is just buying calls if you're bullish, or puts if you're bearish. Now, here's the problem. If you're buying only calls or puts, you must be right 3 times. You must be right on the direction of the move, you must be right on the size of the move, and the timing. If you're wrong just in one of them, the trade will probably lose money. And you will also find out very quickly that options are a wasting asset. They lose money every day. And if a stock doesn't move, as we have seen with the Apple example, the option is losing money. If it moves but not fast enough, it is losing money as well. It is called negative theta. And another factor that having a great impact on options value is implied volatility. Rising implied volatility will increase the option value. Falling implied volatility will decrease it. So basically, when I started to trade options, like probably most of beginners, I started with buying puts and calls as well. But over time, I came into conclusion that to decrease my risk, I would like to achieve the following 3 goals when trading options. I don't want to bet on the direction of a stock. I want to minimize the effect of the time decay, and I want to take advantage of the rising IV. And the strategy of buying a strangle or a straddle before earnings fits all 3 parameters perfectly. So first of all, since I'm buying both calls and puts, I'm not betting on the direction of the stock. So basically, I can make money if the stock goes up or down, it doesn't matter to me. Second, I'm holding for a very short period of time, so the impact of the time decay is minimal. And third, since I'm buying a few days before earnings, implied volatility in most cases will rise into earnings. However, I will be selling just before the announcement, so the options will not suffer from implied volatility collapse. Now, as I mentioned, there are a few scenarios which are possible. First scenario is IV increase is not enough to offset the negative theta, and the stock doesn't move. So if this happens, in most cases, we're going probably to have a small loss, 7 to 10%, maybe slightly more or less. And it is very unlikely to lose more than 10 to 15%. Now, second scenario is IV increase offsets the negative theta and the stock doesn't move. In this case, depending on the size of the IV increase, the gains are likely to be in the 5 to 20% range. In some rare cases, IV increase will be dramatic enough to produce 30 to 40% gains. This is not typical, but it could happen sometimes. Third case is implied volatility goes up, followed by the stock movement. Now, this is where the strategy really shines. It could bring few very significant winners. For example, when Google moved 7% in the first few days on July 2011, the Straddle produced 178% gain. Apple produced a 102% gain, but both cases are relatively rare, and I probably wouldn't bet on this happening. So this is why I call those trades renting a strangle or a straddle for free, or almost free. So even under the most unfavorable conditions, your loss is usually limited to 7 to 10%. Again, sometimes it could be more, but this is pretty much typical. Now, another big advantage of this strategy is the fact that it is not exposed to the gaps in the stock prices. In fact, the opposite, it benefits from them. So if you buy a call, for example, and stock opens 5% down the next day, you're going to experience a catastrophic loss. But when we have both puts and calls, you actually are not afraid of gaps, the opposite. So selection of strikes and expiration. I would like to start the trade as delta neutral as possible. That means usually going with a strike which is the closest to the stock price. So usually if we have strikes, let's say, in $5 increments, like 100, 105, 110, and the stock trades at 104, for example, I would prefer to start the trade when the stock goes as close to the strike as possible. And if the stock starts to move away from the strike, I will usually roll the trade to stay delta neutral. To be clear, rolling is not critical, it just helps us to stay delta neutral. And in case you didn't roll and the stock continues moving in the same direction, you can actually have higher gains. But if the stock reverses, you will be in better position if you roll. So again, over time, you will do probably better by rolling, by staying as delta neutral as possible, but it's not critical. So I usually select expiration at least 2 weeks from the earnings to reduce the negative theta. Now, there are exceptions for each rule, and there are some stocks that I prefer to go with as close expiration as possible, and we will see some examples. And the farther the expiration, the more conservative the trade is, because your negative theta is basically becomes smaller. So going with closer expiration increases both the risk, negative theta, and the reward, positive gamma. So if you expect the stock to move, going with closer expiration might be a better trade. Profit target and stop loss. My typical profit target on Straddles is 10 to 15%. I might increase it in more volatile markets. Now, usually I don't have standing orders to close the trade, especially not overnight, because what happens if the stock gaps in either direction, in the morning, the gain could become much larger than 10-15%. So I don't want to leave money on the table. On the other hand, during the day, if I see that the stock doesn't move or moves a little bit, I can definitely put an order to close at maybe 15%. Now, I usually don't set a stop loss on the straddle, and the reason is that the upcoming earnings will usually set some kind of floor under the price of the straddle. So even if negative theta is more than the increase in the implied volatility, it is still very unlikely that the trade will lose much more than 5-10%. And again, I believe our biggest loss on the straddle was around 25%. Now the risk. The biggest risk of those trades is pre-announcement. If a company pre-announces earnings before the planned date, the implied volatility of the options will collapse, and the straddle can be a big loser. Now, pre-announcement usually means that the results will be not as expected, which in most cases causes the stock to move. So most of the time, even if a pre-announcement happens, the loss will be not too high, especially if there is still more than 2 weeks to expiration, but this is a risk that still you need to consider. And as a rule, I will always close those trades before earnings. Now, why I don't hold through earnings? Some people would argue that selling before earnings is premature. Why not to hold through earnings, hoping for a big move? And the problem is that you are not the only one knowing that earnings are coming. Everyone knows that those stocks moves a lot after earnings, and usually those options will be overpriced. Now, there are always exceptions. For example, stocks like Amazon or Netflix could be very profitable during some of the last cycles because some of the cycles they moved more than the options implied. However, we have to remember that those stocks experience much larger moves than the average move in the last few cycles. So those stocks are usually exceptions and not the rule. Now, some people might argue that if the trade is not profitable the same day, you can continue holding or selling only the winning side, and it can work under certain conditions. But to me, this becomes a little bit more like gambling and not trading. Because once you played the earnings, you hope for a big move didn't happen, you are now sitting on the big loss. So right now, you are hoping that the move will happen sometime after the earnings. And as we know, hope is not strategy, at least not to me. Okay, the bottom line. Over time, options tend to overprice the potential move. Those options experience huge volatility drop the day after the earnings are announced. In most cases, this drop erases most of the gains. Okay, let's take a look at a couple of test cases. Test case number 1. In July 28, 2014, we purchased Expedia 80 Straddle expiring in 18 days. So let's go to One Software, July 28, 2014. So Expedia. And we go to July 28. Here we go. Okay, so this is the Straddle that we bought the same day. We paid $845, and the earnings were expected to be on the Thursday, so 3 days later. So let's see how did it perform. And so the stock was at 80, so pretty much at the strike, we bought 80 Straddle, 80 calls and 80 puts. And let's see IV change. So at the beginning, IV actually decreased a little bit, and this is why the trade started as a small loser. So let's go and see how did it perform. You can see that I can go by interval as small as 5 minutes. Let's use interval of 1 hour. So right now we are on Tuesday, which is next day, and we can see that IV was actually slightly down. So our timing was not perfect, and some members actually bought it at the lower prices. But as we got closer to expiration, we can see that IV already up by 6 points for calls and 4 points by puts. And the stock hardly moved, but the trade is already up 6%. Let's go further in time. We're still on Tuesday. So now the implied volatility is up by 9 points and the trade is up 12%. So let's see when we sold it. We sold it on 2 days later, so on Wednesday. So we need to go to Wednesday. On Wednesday, the implied volatility is already up by 16 points and the trade is up 19%. And this is, I believe, where we sold it. Let's see. Yeah, we basically sold it for 16.6% gain. and an hour later it reached 80%, and the straddle could be sold for 26% gain. Let's see it here. Yeah, the trade is up 25%. All right, let's see another example. Another example was, so in this case, the stock basically almost didn't move, and all the gains came from implied volatility increase. So let's see another example. Another example is Microsoft, June 24. So Microsoft, June 24. We bought 42 straddles with the stock trading at 42. Now this trade took a little bit longer. Basically, we closed it on July 17, and let's see why. So this one, let's go day by day. So where is our straddle? We went with August straddle. Now, typically, I don't like to go to enter as early as this one, but the price was just too good to pass. So I entered, I think it was around a month before earnings. So as we go, the trade is slightly up, 2% up, slightly down, break even. So the implied volatility did go up, but it didn't go up quickly enough, and negative theta was stronger. So the trade at this point is down almost 3%. But even when implied volatility didn't go up as we expected, okay, at this point we are down 12%. But I'm still in the trade. Why? Because if I thought that the trade is cheap at $226, at 197, it's even cheaper. So let's see. Let's go a few days more. Now we are down only 3%. And the next day, we are up 13%. So when the day started, we were up 33%. And why? Because the stock moved 3%. The stock moved 3%, the stock moved from the strike, and implied volatility also jumped. And this allowed us to book around 35%. Let's see how much. Yes, we booked 35.4% gain. And in this case, most of the gains came from the stock movement, but also from IV increase. All right, conclusion. Buying a straddle or a strangle a few days before earnings can be a very profitable strategy if used properly. Of course, like we mentioned, the devil is in the details. There are many moving parts to the strategy, when to enter, which stocks to use, how to manage your position, and when to take profits, etc., etc. But overall, this strategy has been working very well for us. And just take a look how we did in August 2011 crisis. As we can see, many strangles or straddles produced triple-digit gains, because what happened in August, we entered when the implied volatility was very low, and it basically jumped. Plus, the stocks started to move a lot. So basically, implied volatility combined with stocks moving provided us with those extremely high gains. But please don't build on those gains. Don't count on those gains. Usually, it's very rare for those gains to happen. Typically, again, we would be very happy with 10 to 15%. But from time to time, you can get those outside gains when the market becomes really volatile. All right, that's it for today. And let's open to some questions. So basically, you can raise your hand or you can just type your question in the chat window. Okay, no questions? All right, how do you decide if you okay. How do you decide if you choose calendars or straddles before earnings? Okay, good question. It's mostly backtesting. So some stocks will perform better with straddles, some will perform better with calendars. It really goes by stock basis. For example, stock like Apple or Google will usually perform better with calendars. And this is why we're doing calendars. Straddles, again, stock basis. Do you find it useful to monitor IV day by day before entering a straddle? Yes, but I pay more attention to the actual price and not the implied volatility, because implied volatility, it's another piece of information, but if implied volatility will basically increase almost 100% of the time. I mean, it's very rare that implied volatility will not increase before earnings. So the big question is if implied volatility increase is enough to offset the loss from theta. And this is why the price of straddle is more important than the implied volatility itself. All right. Are you using the open software to determine the best price and how? I assume you meant the one software. Yes. So I do my backtesting, my independent backtesting using one software. And we also use the charts prepared by one of our members, Dustin. And I usually cross-reference them, and usually I reach pretty much the same conclusion. So yes, I go usually 2, 3, 4 cycles back and see the price and compare it with the current price to see if the price is good. And I also have to compare apples to apples. So if I compare expiration going out, let's say 2 weeks, I have to compare with the 2 weeks expiration with in previous cycles. I cannot compare price of straddle expiring 2 weeks in current cycle with price expiring in month in previous cycle. I always have to compare apples to apples, which means same expiration. And also we have to remember that if the price is different right now, we have to work on percentage basis. So if the strike is right now $100 and the straddle is $10, that means 10%. So if 5 cycles ago the price was $50, I will look at to compare on a percentage basis. So I will look at the $5 straddle on a $50 stock. Will you be doing any regular webinars for subscribers? I definitely hope so, yes. How do we learn this strategy? I missed the first 6 minutes of this presentation. How do I contact customer service for steady options? Okay, so first of all, this webinar will be recorded and it will be put on the public area of the website and also on YouTube. And to contact customer service for steady options, which is basically myself, you just go to steadyoptions.com website, and there is a email there to contact us. It's info@steadyoptions.com. How do you determine a good price for earnings for entering the trade? So again, it's based on comparing the price with previous cycles. So if previous cycles, we have seen that the price is pretty much, let's say, 5% of the stock price, we're looking to enter at more or less same or similar prices. Would it be possible to show an example backtest? Yes. Do you use option slam to research earnings trades, and if so, what do you find useful there? Okay. Yes, I do use option slam, and we can actually take an example. Option slam. Okay, so we can see basically one of example of some of the upcoming earnings. Let's see. So this is basically how, to those who are not members, this is basically how it works. I post a list of candidates every week, and we're doing some charts. This is the charts that I mentioned. So for example, for stock like DE, we can see relative value. So you can see both lines represent values in the previous cycles, and this is the live price. So we can see that live price is significantly higher than it was a few cycles ago, and this is why DE wouldn't be a good candidate. And I can confirm the same thing in option slam. So if I go to DE and I go to implied move monthly, okay, I am not logged in. So anyway, if I was logged in, I don't remember currently my password, but if I was logged in, I would see all previous cycles. But here we can see that current price is 8.55 compared to previous cycles, which was 6%. So we can see that this is significantly higher than a previous cycle. And my guess is that if it would show previous cycles, it would show similar numbers for previous cycles, around 6%. And since the current is 8.55%, it means that it's way too expensive. And this is pretty much what we see on this chart. Now, let's take an example for some of our recent trades to see how basically, how does it work. So it was last Tuesday, I opened a discussion topic for HD trade. And this is basically how it will always work. I will open a discussion topic and we will discuss those trades. So HD reports on Tuesday, November 17. Current price is 124 and November straddle is trading around 450. And backtesting shows that the best time to enter was around 4 to 5 days before earnings, so around Wednesday, Thursday. And November straddle will be fairly aggressive trade due to high negative theta. This is basically what I mentioned, that close expiration will mean usually much more aggressive trade because of high negative theta. But in this case, the holding time will be very short. And also based on previous cycles, we know that the HD usually performs the best with close expiration. So I also mentioned that I will be aiming for a 410 to 420 entry, and current price was 450. And we should get there in 1 to 2 days. And this was on Tuesday. So on Wednesday, one of the members posted still too expensive this morning at 4.3, and what would potentially make these straddles come down in price. And I said that the IV sometimes goes down a little bit, at least temporary. And on Thursday, I entered the straddle at 413, which is exactly inside my range of 410 to 420. And members started to post their fills as well, 418, 415, 417, 415, 415, 414. And I said that I will be looking to roll 123 puts to stay delta neutral. And I rolled the puts, and the next day, some of our members rolled as well. Now we are Friday at the Friday morning, and I rolled the calls as well because the stock moved a little bit more. So now some members already started to close the trade. Never rolled yesterday, but just got out at 480. Was 15% gain in 2 days. It was actually 1 day. And our members exited at 512, 475, close to 13% gain, etc., etc. 28% gain, and at this point, I posted that I was out at 470, including 7 cents credit from the rolls. This is 15% gain. And as you can see, many members actually did even better, 18%, 23%, 21%. And this is, by the way, this is real form. I mean, I'm not making this out. You can see that this is how we work. This is how our members follow us. This is how we discuss the trades. This is real example from just last week. Okay. I don't understand the difference between 1 day final move and 1 day max move. Aren't they both averages? They are averages, but if the stock moves maximum amount in the day after earnings, by taking the maximum amount and average the maximum amount over 4 cycles. And we also take the final move, which is closing price, and also average them over 4 cycles. And those are different numbers because the final move will be usually smaller than the maximum move, because intraday stock can move much more, and then to retrace and to close at the smaller move as final move. But we can still average those final moves and maximum moves over the last 4 cycles. I hope this answered the question. All right, more questions. We have still a few minutes. And again, we can you can always contact me at info@steadyoptions.com if you have any questions. All right, we have another questions here. Kim, do your members have to constantly monitor your site, or do you send out alerts, email, text message, etc., when you make a recommendation such as the HD example? Okay, so the way it goes, the way it works, basically, here is the discussion. And if I go to the trades topic, which is basically the trade itself, there is a button here says follow or unfollow this topic. So if you follow, so let's go back to steady options trades. So here is the list of all trades that we did. And here, members can follow or unfollow this forum. So when you follow the forum, you will get an email each time a trade is posted on the forum. And when you follow the individual topic, you will get all the adjustments like adjustment, rolling, or closing the trade on this individual trade. So if we go to frequently asked questions, which is open for everyone, not only members. And one of the questions is, how do I get the trade alerts? So I will post a topic in the Steady Options Trades forum when I enter or exit a trade. If you want to get notification about the trade, you should follow this forum by clicking follow this forum button. If you follow this forum, you will receive an email when a new topic trade is posted. If you want to follow that trade, you will have to follow that specific topic in order to get notifications about the new posts in that topic. And to get notifications from any forum, you need to follow that forum and then each topic individually. Now, how to get notifications, it's up to you. You can specify that you want to get it by email. You can specify that you want to get it inline notification in the forum, etc. And you can also follow me on Twitter at protected account, Twitter Steady Options. And this is how you get the trade alerts. And by the way, just one comment. It's not a trade recommendation because, as I mentioned many times, Steady Options is not a recommendation letter. I am not a financial advisor. All I do is sharing my trades with members, and members can select if they want to follow the trades, if they want to just to paper trade it or just to learn. It's up to you. But it's definitely not a trade recommendation. All right. Can you go back to Dustin chart and take us through your logic again on the HD trade? Okay. So we need to go to previous week. This one. Okay. So straddles, let's see a relative value. So relative value for the straddle was basically life value. Let's see. Current is 3.65%. Okay, let's see. Yes, okay. So the straddle itself was 458 when this chart was posted, which is 3.65%, and we can see it here, live 3.65. So as you can see, it is still reasonably priced, but I still wanted to see it a little bit lower in order to have a little bit more margin of safety. Because if we enter at this price, as you can see, and we basically entered 3 trading days before earnings, so pretty much here, as you can see, in some of the cycles, the price was actually lower. So I wanted to see it more or less here, which is more or less 3.4% of the stock price. So let's do the math. 124 stock price multiplied by 3.4 gives us 421. And this is more or less the range that I specified, 4.10 to 4.20. Again, I just wanted to have a little bit more margin of safety, and I knew based on previous cycles that on Thursday we can actually see the price going down. So because HD is one of those stocks that have pretty much a very similar behavior, cycle like after cycle. Implied volatility goes down slightly on Thursday, 2 days before, 2 trading days before earnings, and this is where I usually prefer to enter. All right, I think we're done here. So thank you very much for attending. I will make the recording and will make it available on the forum and on YouTube. And again, you can contact me at info@steadyoptions.com. This is Kim Kleiman from steadyoptions.com. Thank you, everyone, and goodbye. See you. See you in the forum.